Let's take a look at some of the basic types of stock market orders. Now, there are several ways to classify orders in the stock market. One way we classify them is by the number of shares or sort of the size of the transaction. Odd lot orders are orders for less than 100 shares of stock. And these tend to be small investors, and they're small because they can't afford to buy 100 shares or they choose not to purchase 100 shares. It tends to be rather expensive to engage in odd lot trading. If you happen to be a small investor and you don't have enough money to buy 100 shares of a stock because you want to diversify your portfolio and you want to buy shares in a number of different stocks, it may be better simply to buy a mutual fund. Odd lot orders actually come into play in technical analysis because a lot of people will watch and see what's happening with the odd lot orders because they can see what small investors are doing. And the assumption in technical analysis is that small traders, small investors don't really know what they're doing. So if they're buying, that's a sell sign, or if they're selling, that's a buy sign. Okay. Another way to classify is the round lot order. And the round lot is an order of 100 shares or some multiple of 100 shares. So if you buy 200 or 300 shares, that's a round lot order. And that's generally what you want to do, because if you only bought 3 shares of a stock, the commissions would be very expensive. So these would be at least higher net worth individuals, or obviously mutual funds, pension funds. They can afford to buy thousands of shares. Sometimes they're buying hundreds of thousands of shares or millions of shares. So they're always buying in round lots. Another way to classify the basic type of order is when you want the transaction to take place, or at what price you want the transaction to take place. And a market order is the case where you tell your broker to buy or sell the stock at the best available price, and the order gets filled very, very quickly because the broker is not looking to get a higher or a lower price for you. The person just fills it. You say, okay, I want to buy 100 shares of Microsoft stock, and they buy you 100 shares of Microsoft stock at whatever the prevailing price is. Now, if we want to move on, you can engage in some sort of transactions that will protect you should the price of the stock fall or should the price of the stock rise. And these are referred to as limit orders. So a limit order is an order to buy at or below a specified price, or if you happen to have a limit order to sell, it's to sell at or above a specified price. So essentially it's saying, hey, here's the price I want. I want to be able to buy at $100 a share or better. So if the price falls to 100, your broker would, or the market maker would fill the order. Or if it fell to 99 or 98 or 97, they would fill the order. Similarly, if you put in a limit order to sell and you said, I want to sell this for $75 a share, they'll sell it at 75 or higher. But if the price limits aren't met, the order is not filled. So let's say the price of the stock is 101 and you have an order to buy, a limit order to buy at 100, that order is never going to be filled. When you specify a limit order, there are several ways you specify it. You can specify fill or kill, which means that either fill the order immediately or cancel the order. You can have a day order. So you put in today, I want to buy Microsoft at 100, and if it falls to 100 or below, the order gets filled. If not, the order expires. You can also have good till canceled orders, and these are limit orders, and they remain in effect for 6 months unless they're filled or either canceled or renewed. Okay. A couple other types of orders that are similar to limit orders are stop-loss orders. A stop-loss order is used much like a limit order. If you were selling your stock and you said, look, I put in a limit order of 100, it has to be sold at 100 or better. You could put in a stop loss order at 100 as well. Now, the difference is that once it hits 100, it becomes a market order. And so this is the case where if the price hits 100, it becomes a market order, and you could wind up selling your stock not for 100, but maybe for 98 or 97, depending on how quickly the stock price is falling. But it still is a way to protect yourself from the price of the stock falling a great deal, because if you have this stop loss order in, at least this sell order will kick in once it hits whatever that price is. And again, you can have day orders or good till canceled orders, but again, it becomes active. In fact, they refer to these as a suspended order. So it's an order that's not in place until the price falls to a specified level. You can also use a stop order to buy stocks. If you short sell a stock, this is the case where you sell a stock that you don't own and you're planning to repurchase it at a later date, hopefully at a lower price, so you bought low and sold high. And you can put in a stop order to buy the stock just in case, to protect yourself in case the price of the stock keeps rising, so that you didn't short sell it at 100 and wind up buying it back for $200 a share. So you might put in a stop buy order at maybe 102 or 105 to protect yourself. If you're worried that the stop loss order, when it kicks in, is going to get you a poor price if the price is falling rather quickly, you might put in a stop limit order. In this case, it's an order that says it kicks in once the price hits that price you specified, but they can't sell it at a worse price. So if you're selling the stock, if the price is 100, it has to be sold for 100 or more. And no sale may occur if prices continue to decline. So you're protecting yourself. If the stock goes to 0, you might be glad you had a stop loss order instead of a stop limit order. But you can put this in saying, look, if it falls to, I want to sell it at 100, but if it falls to 95, I don't want to get rid of it. Okay, that's too big a loss. I'll hang on to it, and I'll try, and I'll hope that it comes back. So there are several types of orders you can put in to protect yourself. And again, the difference between the limit order and the stop loss order is that the limit order requires that the price be at the price you specified or a better price, where the stop loss order just becomes a market order once that price is reached.